If you missed last week's volatility, don't be worried, there might be more volatile sessions this week as the Bank of Japan, the Fed, and the Bank of England are announcing their rate decisions this week. And we expect three different outcomes in each case. The Fed is expected to keep interest rates steady, the Bank of Japan might hike interest rates, and the Bank of England might proceed with a rate cut. While we shouldn't forget that the US nonfarm payrolls are also on the agenda this Friday, so investors might have a lot of information to digest, and therefore we may see strong movement in FX markets. So in this video, I'm here today to analyze the technical outlook of dollar yen, gold, and pound dollar. And before we start, let me first apologize for my sore throat. I will do my best to sound as clear as I can. So starting first with dollar yen. And the Fed is expected to keep interest rates steady, as I said before, so all the attention will turn to the communication, to the central bank's communication, as there are no updates of dot plots or new economic projections. So if the Fed sounds more hawkish than expected, if the central bank questions the case of a second rate cut this year, we may see the US dollar rising, and in this case the pair could capitalize near the 23.6% Fibonacci retracement of this outlook over here, which has been supporting the market for a couple of days now. So a bounce here could take us initially near the 155 level, where this constraining ascending line is located, while higher than that there's another falling line around 156.40, which may attract attention before we reach the 20 and 50-day moving averages near 157.90. Well, from a technical perspective, while the RSI and the stochastic oscillators are near their oversold levels, so that might justify a rebound in the price. However, if the pair reverses to the downside, and this could happen if Powell endorses the case of rate cuts, and also if US nonfarm payrolls disappoint, if they come lower than expected, increasing the case of more than a rate cut this year. So in this case, dollar yen could drift lower to test the 200-day moving average, currently near 151.55, while the 151 level could also attract attention because this is where the 50% Fibonacci retracement of this outlook is located. So a break below that might motivate fresh selling towards the 148.53 level, which is the 61.8% Fibonacci retracement level, unless of course the 149.85 territory, which has been constraining upside movements in the past, manages to stop the sell-off. Now looking at pound dollar and the Bank of England's rate decision, the base scenario is for the central bank to cut interest rates by 25 basis points. Nevertheless, futures markets suggest that the debate could be tough. 5 out of 9 policymakers are expected to vote for a rate cut, but it remains to be seen whether fewer policymakers will vote for a rate cut. So if the central bank cut interest rates, this is already priced in, so perhaps we may see some sell-off, but overall declines could be limited. If, however, the central bank uses also a dovish communication, if it signals more rate cuts, then pound dollar could move lower, probably towards the 1.2730, 1.2750 territory. We shouldn't forget that inflation in the UK is around the central bank's 2% target, so perhaps if the central bank acknowledges that, and if it signals more progress on the inflation front, that could sound dovish to investors, likely causing more sell-off. So from a technical perspective, while a break below the 1.2730, 1.2750 region might cause a stronger decline, probably towards the 200-day moving average, and this longer term ascending trend line coming from the lows of 2022 that is seen around the 1.2635 and 1.2615 level, while lower than that the price could perhaps retest this falling constraining line near 1.2580. Well, if you look at the RSI and the stochastics, the stochastic oscillator is near 20 and the RSI is testing its 50 neutral mark, so that could justify a rebound, but overall the close below the drop below the 20-day moving average today is increasing the odds for more declines. Nevertheless, if the pair manages to bounce up and perhaps a hawkish communication, a hawkish rate cut by the Bank of England could help the pair in this case, well, then the focus will turn back to the 1.2937 level, where the price faced some resistance last week, and higher than that, probably the pair may attempt to cross back above the 1.30 and 1.3012 constraining zone in order to reactivate this up leg. Now looking at gold, well, gold could move on Wednesday when the FOMC policy decision comes out. We don't expect any surprises during this week's FOMC policy meeting, so all the attention will turn to the Fed's communication, although the Jackson Hole Symposium later in August might be an opportunity for the central bank to change its language if unexpected economic developments take place. So no surprises during this week's FOMC policy meeting, but Friday's nonfarm payrolls report could affect market sentiment, could affect future rate cuts. For example, a weaker than expected nonfarm payrolls report might weigh on the US dollar and therefore could help gold to extend this upturn. And in this case, initial resistance could come near the 2410 level, which coincides with the 38.2% Fibonacci retracement of this up leg. Higher than that, the next obstacle could occur near the 2430 and 2438 resistance territory, where the 23.6% Fibonacci mark is also located. While higher than that, gold will attempt to cross the 2457 and 2470 resistance region and also retest this constraining ascending line over here near 2483. This is where the price printed its recent record high. Now from a technical perspective, well, we can see that the RSI is near 50, the stochastic oscillator is trying to rebound, so there is some opportunity for more progress, for more recovery, but if the 20-day moving average and the 50% Fibonacci mark of 2388 manages to pose the latest upturn, we may see another retest of this key ascending trend line coming from February 2024. That line is around the 61.8% Fibonacci mark of 2366, and the 50-day moving average is also nearby, so a break below that territory might cause more sell-off towards the 2325 level. And failure to pivot here could then directly send us down to the crucial support zone of around 2290, where the price rotated higher almost 3 times since April. So that's all from me today, guys. Wow, thank you for watching, and don't forget that our next technical update will be this Thursday. So for now, I wish you have a great trading week, and I will see you next time. Bye bye for now.